In working capital management, we have to cover three aspects in this class. One is related to cash management, another one is financing of working capital, along with Tandon Committee's recommendation, and some theoretical aspects also. Treasury or cash management. Okay, we have to understand three aspects here. One is Baumol model, another one is Miller R model, last one is cash budget. Baumol model, where Baumol recommends the economic lot size for keeping the cash in FD and converting that to ready cash mode. Okay, and how much cash you can keep in your cash box for meeting your expenses also be considered as the optimum cash balance, Miller R model. And third one is all about cash budget. This Baumol model, is similar to economic ordering quantity. Like Miller R model, optimum cash balance is nothing but level of quantity you maintain. Okay, real level, maximum level, minimum level. Like similarly, how much cash you can have readily available for disbursement in your cash box, not more than this much. If you hold more than the requirement, unwantedly you are wasting your money to earn some return, right? If you could have deposited some banks, you may generate some interest. If you are keeping that in your box, it will generate nothing. If you are keeping lower than the required fund, then your business gets stuck on payment, right? So you have to understand how much you have to keep in your hand, optimum cash balance. These are the three practical problems you have to understand here. Cash budget. So this cash budget you'll study in management account as budgetary control. There also you'll study, here also you'll study the same illustration, right? Now, under cash management, what do you do? Planning, organizing, directing, and controlling the cash. These are the predominant functions you have to do. How much cash required to maintain? If the cash is in shortage, how can we finance? If there is any cash surplus, how can we keep that safer to generate income? Investing. Cash deficit, our intention is to minimize interest cost in such a way you can finance. In case of cash surplus, you can invest in such a way that you will get maximum interest income. So this is what about the cash management. Cash budget is nothing but a statement of inflow and outflow, finding the balance for every period. The main motives, why do you want to have the cash? For the day-to-day running, you need to maintain the cash, right? Day-to-day operations. That is called transactive motive. Some emergency requirement may also happen. For that, you need to meet. Then it's called speculative motive. And beyond that, some precautionary requirement also be there to keep the cash balance always available with you. And you have to understand the float. So nowadays, the float becomes invalid or irredundant because earlier, no, the payment is routed through check only. So if I raise the check on you, so I'll send the check to you. You'll deposit that in the banker. Your banker will confirm and collect from my banker. So it will take around 15 days or even 1 day, 1 month also to get settled. If I have only 1,000 rupees in my bank today, I may issue the check for 10,000 rupees. Before it gets collected, I may deposit remaining 10,000 rupees to honor my check. This is how earlier they play the game. So they don't have the cash, but they issue the check. The payment seems to be done like, but actually payment is still pending. Is it harmful for the business? Definitely not. So they can manage this. This is called float. The period delay, okay, is called check float. Okay, so float is nothing but the difference between total amount of checks drawn and then the bank balance as per the bank book is called float. You have drawn almost 1 lakh rupees worth of check, but you have only 10,000 balance in your book. 90,000 rupees shortage is called float. Now the question is, will the check dishonor? Definitely not. So we know matter of 1 week later only they will come for the collections. Beforehand, I will deposit and honor the check. That's how we'll do it. But today everything is NEFT transfer. Matter of half an hour, the fund is transferred from my account to other account. So float becomes outdated concepts today. The period during which the checks issued are expected to be presented for encashment is called float period. So 1 week or 10 days. I issued the check before it get collected. It takes at least 1 week or 10 days. Then it's called float period. Hope you'll be now able to understand float and float period. So what are the types of floats we have? We have billing float, mail float, check processing float, banking processing float. So these are the four floats we have. Billing float is nothing but delaying the bill. After the work is done, okay, if I ask the supplier to make the bill ready, sir, wait, sir, I will take 2 or 3 days time to get the bill ready. Because it's again time consuming one. For the building contractor, he'll purchase a lot of things. I may also make the payment. And finally, if I ask for the bill, wait, sir, I'll calculate out all these things. So, if for a week's period, he could have purchased cement and steel, rods, and may be payable for laborer and sand, and sometimes it may be subcontract. He has to work all these things. It takes 2 or 3 days. So, I'll tell them. So, I'll make the payment after you submit the bill. So, naturally, what happens? The billing date the bill submission date may be delayed. So, I may enjoy the 3 or 4 days credit period, like, right? So time gap between the actual sale and mailing the invoice. That's called billing float. If I'm reducing the billing period, I can get the money quicker if I'm being the supplier. Okay. If I'm being the supplier, the customer will always demand to get the bill for settlement. So I'll tell you, wait for sir. I will send the bill within a week's period. So within a week's period, if I send, and after that he will pay the money. So if I'm able to send the bill immediately, then what happens? I can get the collections immediately. So billing float, that is called billing float, mail float, check processing float, banking processing float. So these are the different types of floats we have. Clear? So billing float is nothing but the after the sale, the time taken for billing. Check mail float is bill is ready. I am sending that in mail. No, it takes some time. So this is called mail float. Check processing float. Okay, I issue the check and before it gets cleared, it takes some time. Banking side delay. All these things are called floats. So these are the floats earlier days, made the payment delay. Made the payment delay. So in order to avoid earlier, no, we had a concentration banking. Now again, this is not required. Okay. System operating through several collection centers. Okay, this is what speed up the collections. See what happens, earlier in India probably is a Delhi and Tamil Nadu. I get the goods supplied from Delhi customer seller and I issue the check, okay, from my bank SBA, and Delhi he has a Canara Bank. You understand? This supplier gets my check and deposits that to Canara Bank, and Canara Bank cross verifies by sending this to the SBA and confirms the amount available and gets credited. While sending, it takes 7 days, and while confirmation, it takes another 7 days. So naturally, 14 to even 30 days also it takes to get it credited. But nowadays, what happens? Everything is scored out. It's simple. So in order to avoid that earlier day, what they do know, very simple, they will have lots of banks. Here, this Delhi supplier will have a bank in Trichy, Chennai, and Delhi nearby. So if the buyers are from Trichy, ask them to pay the money in the Trichy branch itself, and the people purchasing from Chennai can deposit nearby. So that's how they can reduce. This is called concentration banking. All these things are outdated today. Okay. Now, because of that, what is the annual interest saved in case of concentration banking? Very rare question. Very rare questions. We'll understand. See, earlier we have only one bank account, right, in one centralized place. Uh, if you are having numerous branch accounts or different bank accounts, so that you can collect faster. Earlier, without that, you waited for 10 days. Because of the concentration banking, we can get it in 2 days. The daily collection maybe say 1 lakh. So what happens, 8 days amount you collected ahead. It means 8 lakhs you are getting ahead means what is the interest rate applicable. So for example, the company pays around 12% for their borrowings, means for the 8 lakhs, 12% will be the savings. So average collection period maybe 10 days. Reduction in mailing and processing time due to the concentration banking. Okay, maybe around 8 days reduced. This is minus, make a minus. 10 days minus 8 days. Now we can finish off by 2 days. Rate of interest applicable then. So that's how we'll calculate. That's how we can calculate. It's also very rare. Apart from that, we had lockbox system also. Lockbox system. In post office, no, you may see some post office box number. Have you heard about post office box number? Anybody? Post office box number. All these things are today outdated, like post office box numbers. So if you want to send your resume to companies, sometimes the company may be very reputed company. So if you are sending the resume to that company, what happens immediately? You try to influence the company to based on somebody else. Or do you know somebody else to recommend me to get the appointment there and all? In order to avoid that, no, the company will rent a box from post office. Every post office will have the boxes, small boxes, right? It will have the numbers like 105. Like SSA wants to appoint the faculty here. I just uh, get a rental a post box. The post box number may be 105. I asked the others to post their resume for faculty posting representing this box. So all the resume will come here. Then I will take this and call for the interview. That's how I will do. So no one knows who has called. So this is called the lock box system. So rents the post office box at different locations, collects the remittances in the post office box. Everything is collected here. Authorizes its banks to collect the payments from the post office for the credit. So we authorize the banks to collect the checks deposited here to encash it immediately. Don't wait for me. So this is a process called lockbox system. Is that clear? Now here you see SSA Limited feels a lockbox system can shorten ACP by 3 days. Credit sales are estimated 365 lakhs per year. Billed on a continuous basis, the firm's opportunity cost of funds is 15%. The cost of lockbox system is 50,000 rupees. So, because of having the lockbox system, ACP is reduced by 3 days. So, 3 days collections will be available in your hand ahead. So, otherwise, 3 days collection will be saved for the entire year. You no need to fund for that. So, 365 lakhs is the annual sales. 3 days sales being 3 lakhs. Entire 3 lakhs now you receive in advance. For that, the interest rate applicable being 15%. Come on, what is the interest saved here? Interest saved. What's the value? 45,000. Now, in order to implement this lockbox system, we have to pay the rent for the lockbox. Okay, lockbox cost. How much is that? 50,000 rupees I had to spend. After spending this, actually net benefit is negative only. Will it be advisable? Definitely not advisable. So, spending 50,000 to save 45,000 has no meaning. So, we should not accept. Will your answer be different if the ACP is reduced by 5 days? In case of 5 days, what happens? 365 lakhs into 5 by 365 into 15%. I think 75,000 will be the savings and lockbox cost being 50,000 rupees. So you save 25,000. In this case, you can definitely accept this. You can accept this. Clear? Shall I move to the next one? It's very simple. You may expect very rarely. You can expect very rarely. Shall I move on to the next one? Yeah. Let's start with cash management model by William J. Baumol, otherwise Baumol model. Come on, tell me this. The annual cash requirement of A Limited is 10 lakhs. The company has marketable securities in lot size of 50, 1 lakh, 2 lakhs, and 2.5 lakhs, and 5 lakhs each. Cost of conversion of marketable securities per lot is 1000. The company earned 5% annual yield on its securities. You are required to prepare a table indicating which lot size will have to be sold by the company. Also show that the economic lot size can be obtained by the Baumol model, economic lot size. So we can prepare the table. Table is nothing but the tabular model we use for EOQ. The same way we have the tabular model also. Here we can use a formula as well as tabular both. So in EOQ, the formula being what? Root of 2AO by C. Here, okay, economic lot size, okay. Economic lot size, here the formula being to annual requirement in rupees. Their annual requirement in quantity, right? Here, annual requirement of cash. There it's ordering cost, it's nothing but conversion cost. Conversion cost means you may deposit the FD, you withdraw the FD. If you keep the amount in current account, you don't get any interest. So what you can do, you can deposit the fixed deposits, you will get the interest. Do I want to keep the entire 10 lakhs in FD or 1 lakh like FD? That's what about the lot size I'm going to consider here. So here transaction cost. O is equal to the transaction cost. Transaction cost is nothing but withdrawal of the FD. Issuing the FD, purchasing the FD and withdrawing the FD. Okay, divided by carrying cost, like here, if you are keeping the cash in current account, you don't get any benefit. If you are keeping the investment in FD, you will get return. You will get a return. That is called holding cost. That is called holding cost. Is that clear? Hope now you will be able to understand. Now, economic lot size. In this case, 2 into annual requirement 10 lakhs into transaction cost for converting every lot. Okay, it's ordering like you are converting the FD into normal balance in the current account. It costs us 1000. And your carrying cost, like you have the holding cost, which is 5% interest divided by 0.05. Come on, get me the final value. Hmm? 2 lakhs. 2 lakhs is the lot size. Economic lot size. Anyhow, we can calculate using the tabular model also. Okay, 1 second. So the annual cash requirement in tabular model, how do you solve? Different lot sizes are given. For each and every lot size, you have to calculate the transaction cost as well as holding cost. They are ordering cost and carrying cost. Here, transaction cost and holding cost. So lot size 50,000. 1 lakh, 2 lakhs, 2 lakhs 50,000, 5 lakhs. Now find out transaction cost, TC. How do you calculate this? Annual requirement divided by lot size into transaction cost per transaction 1000. 10 lakhs by 50,000, 20 into 1000, 20,000. Here 10,000. If it is 2 lakhs means 5 orders, 5 into 1000, 5,000. 2.5 lakhs means for every annual requirement 10 lakhs divided by 2.5 lakhs 4 times into 1,000, 4,000. The lot size is 5 lakhs. 5 lakhs into 10 lakhs divided by 5 lakhs, 2 lakhs into 2,000, 1,000 rupees, 2,000 rupees. And holding cost. How do we calculate the holding cost? Holding cost is equivalent to half of the lot size multiplied with the holding cost percentage. First case, lot size is only 50,000 rupees. Don't forget to multiply with half into lot size 50,000 into holding cost being 15%. I do this way. Half is 0.5 into 50,000 into 0.15. What's the value? 3,750. Next one is 0.5 into lot size is 1 lakh into 0.15. It's simply double times, right? 7,500. Then 0.5 into 2 lakhs into 0.15. 15,000. Is it so? First one, holding cost is 5%. Sorry, I got surprise. It's not 15%, it's 5%. Thank you. 0.05. So 1,250, 2,500. The next one being 5,000. If the lot size being 2,50,000 rupees into 0.05, 6,250. Finally, 0.5 into 5 lakhs into 0.05, 12,500. Total cost, the summation of transaction cost and holding cost, 21,250, 21,250, 12,500, 10,000, 10,250, 14,500. So from this it is very clear, the cheapest is only this one. Okay, this is what about the economic lot size, where at economic lot size transaction cost and holding cost should be same, total cost should be cheapest. Is that okay? See what happens, the company can issue 2 lakhs rupees worth marketable securities. Company can issue bond, like they can issue 2 lakhs worth of securities, and in a matter of 360 days divided by how many lot size are there? 5 lot size, right? 5 lots. How many lots? 5 lots. 2 lakhs is per lot size. Yearly requirement being 10 lakhs. Every time 2 lakhs means 5 lots. 5 lots. In 360 days, you convert in 5 times or 5 lots. Then the frequency between one lot to the another lot being how much? 72 days. Once in every 72 days. See what happens, logically you can think this way. What's that? Day 1, you issue. Okay, you issue. Day 1, you just have whatever the balance. By the 72nd date, you sell or you withdraw the 2 lakhs. Issuing and encashing cost us 1,000 rupees, but you withdraw 2 lakhs rupees. Another 72 days, 144, again you withdraw 2 lakhs. Another 72 days, 216 days, another 2 lakhs. And 288, another 2 lakhs. And 366 60 roughly. Okay, then another 2 lakhs. What happens, for this you will get the interest for 72 days for 2 lakhs. 2 lakhs into 0.05 into 72 divided by 360. For this 0.05 into 72, not 72, 144 days interest you will be getting divided by 360. Such a way you will be accumulating interest gain. For 5 times conversion you spend 1000 rupees, 5000 rupees. Instead of that, if you keep all the cash in your hand, what happens? You don't have the transaction cost, but the interest gain of this period lost. Okay, you lose all the interest gain. So you issue the lot size being 2 lakhs, 2 lakhs. I issued 2 lakhs rupees worth of securities or marketable securities to you, another person. By the end of 72nd date, I call for the first security and settle this money. For the 2 lakhs to the 72 days, I get the interest. For the another person, another 72 days later, again I'm withdrawing that. So for him, from him, I'm getting 144 days interest. So I get the interest benefit also. Rather than keeping that deposited in the FD or marketable securities, if I'm keeping that in my current account, I get nothing. So I'm making the benefit out of it. I'm doing this way. So what is the lot size I have to have? 2 lakhs lot size. It's not 50,000 or 1 lakh or any other lot size. This may be the optimum one. Similar to the EOQ here. Clear? Shall I move on to the next one? So here, what are the things are they? Cash management model, William J. Baumol for optimum cash balance. Optimum cash balance is the trade-off between cost of holding cash and transaction cost. How do we work out in case of EOQ? This is ordering cost. This is carrying cost. The point where these two are intersecting, this is called total cost. Okay, this is how we have learned the EBQ. The same diagram we have here. Okay, like ordering cost we have. Okay, this is the cost, holding cost. This one is carrying cost. This is total cost, where these two costs are intersecting. Draw the straight line. The total cost and the tangent, the bottom, it will touch. Okay, already I told you that ordering cost is equal to carrying cost. Similarly here, holding cost is equal to transaction cost. Holding cost is equal to transaction cost. The diagram is also over. So all the formula is similar to what? EOQ. Economic lot size, number of lots, frequency, average cash balance, transaction cost, holding cost, total cost, everything is calculated. We have already learned in EBQ. You replace that here. So assumption also be there. Now we'll move on to the next one. It's called Miller-Orr model. Miller-Orr model. It's a stochastic model, means probability model. We cannot say the cash consumption every day remains constant. I may say that the cash requirement per day may vary anywhere between 1000 to 1500. Maximum it may go up to 1500 rupees requirement, or sometimes it may be 1000. So the requirement is there. We may assume sometimes it may be 1000 and 1500 based on some probability. That's why it is called stochastic or probability model. So here it is all about Miller-Orr model. Optimum cash balance to be maintained when the demand of cash is uncertain. Okay, so if you have cash balance more than your upper limit, you thought you need to keep not more than 1 lakh rupees in your cash box. If your cash box has balance more than that, what you can do? That excess money can be used for investing in securities. If the number is very less than, touches lower limit, immediately try to sell all the securities what you have or arrange for cash requirement. So when the upper limit touches its highest cash balance, buy marketable securities to keep the amount invested in the securities. If it touches the lowest lower limit, this is O represented, and sell marketable securities, and return point. Return point is the average. Okay. See here, a diagram is drawn this way. Diagram is drawn this way. Now, assume that this will be considered as lowest limit, O, lower control limit. This is called lower control limit. Your cash should not go beyond this. This is called upper control limit. Upper control limit. And an average may be anywhere in between this. This is called a return point. This is called a return point. If you assume that the cash you have here, if you start consuming the cash, it will decrease. The moment it touches to the bottom, immediately try to sell all the securities what you have so that you can raise your fund. Suddenly, if it touches, then you start consume. Beyond that, you can sell. So that's how you monitor the cash balance should not go beyond this or below this. Okay, that's the logic. So Z, otherwise named as return point, average, and H represents upper control limit, O represents lower control limit as per Miller R model. We have studied the same like in case of material management, inventory management, where we have the reorder level, minimum level, maximum level. So this is similar to maximum level, this is minimum level, this is the average level. But here we have the stochastic model, so the formula is pretty different. Of course, we cannot calculate these things without scientific calculator. Usually, this question also not asked in your examination. Anyway, we'll try to solve one illustrations for our understanding. Okay, you mug up that formula, not more than that. Okay. So, now, spread are named as Z is equivalent to third root of 3t variance by 4i. 4i. Okay. T represents transaction cost. Already we know. Transaction cost. And I represents daily interest. Okay. Daily interest. Clear? Standard deviation square is nothing but variance. That you know, variance of daily consumption. Variance of daily consumption. Okay. So you will consume daily cash, but it will be varying from the midpoint. That variance will be considered as standard deviation square here. Now, return point. Return point. Return point, otherwise RP is equal to the Z what we calculated in the earlier. With that, you have to add the lower limit. Usually, lower limit is a fixed number given. In case of upper limit, we have two formulae. 3RP minus return point. 3 return point minus 2 lower limit. Or there is one more formula. Lower limit plus 3Z. You will get the same answer, the same formula. Apart from that, average cash. Average cash. The formula being 4 by 3 into Z value plus lower limit. These are the four formulae you have to understand. I could not, I usually in my days, no, I remember this before the examination. Thereafter, it goes out of my memory. Now also, I just refer the question. So, why I am saying is not so important this one, very rare. Third root, you cannot calculate anyhow using a non-scientific calculator, so usually it may not be asked, but if it is asked, then you try to write. At least the theory may be asked. What is the return point and all, so you understand that. That's more than enough. Sunshine Limited expects its cash flows to behave in a random manner as assumed by the Miller R model. The company wants you to establish return point, upper control limit and all. The annual yield on marketable securities is 12%. So 12% means 0.12 daily. It should be divided by 365. Come on, find out the daily interest. 0.00033. Am I right? And fixed cost of effecting the marketable securities transaction. This is nothing but T. This is I. This is T. And standard deviation of the change, standard deviation, but we need to have variance. Standard deviation square is the variance. Every day the cash consumption varies from the midpoint by either upside 5,000 or downside 5,000 rupees. That's called standard deviation. Every day I am consuming say 50,000 means sometimes it may go up to 55, sometimes it may go 45 like that. The management of Sunshine Limited would like to maintain a minimum cash balance. This is called lower limit. This is called lower limit. Now feed the data in this formula. 3 into transaction cost being 1,600 into variance standard deviation square, otherwise variance, which is nothing but 5,000 into 5,000, divided by 4 into rate of interest per day 0.00033. Take the root of this. Take the root of this. Get me the final value. I think this value being 44,964.43. Shall I move on to the next one? In this case, Z is equal to, we calculated this is being 44,964. This you cannot calculate the third root. No, you cannot calculate without scientific calculator. It's third root. Okay. 44,964 plus lower limit being 50,000 given. What's the final answer? 94,964. Upper control limit 3 into return point 44,964 minus 2 into lower limit. Then the final answer being RP is 94, right? 94. The final answer being 1,84,964. 1,84,893. Okay, 893. 893. The last one being lower limit. The other way, either you can calculate this formula or you can use this formula also, no problem. So lower limit 50,000, because here 3, here 2, you can remove 2, right? So then the answer being 50,000 plus 3 times of Z value 94, Z value being 44,964. The same formula, right? Same formula, the same formula. RP includes LL, 2 LL is removed. So only we have 1 LL and 3 of the RP, rest of the RP. That's how you can get the answer. Also, you'll get the same answer. You can do one of the formulae, no issues. The last one being 4 by 3 into Z value being 44,964 and plus LL being 50,000. Final value being 1,09,953. Shall I move on to the next one? Now, next also similar one. You can try it yourself. It's only application of formula. Just application of the formula. Okay. Xeon Limited expects its cash flows to behave in a random manner as assumed by the Miller and Orr model. Xeon wants you to establish return point, upper control limit, everything. Annual yield of marketable securities being this much, then I should be 0.1 divided by 365. Come on, get me the value. Daily interest. Okay, 0.000278. Okay, I can round off the last digit here. This is transaction cost. This will be standard deviation, and this will be the minimum cash balance. So 3 into transaction cost being 2,500 into standard deviation being 10,000 square divided by 4 into rate of interest per day being 0.000278. Take the third route. So if you don't have any other options, you have to apply the third route. Then there is a shortcut to calculate this one also using your non-scientific calculator. It's given in Singar Academy's free lectures video. Calculator tricks you can go, or it's available in YouTube also. Okay, to calculate any roots using your non-scientific calculator, it's given. Go and try this tonight also, no problem. You can try it yourself, no issues. But of course, not required. Even I tried and I kept that and practiced, then it's out of memory, it's not required in the practical life. So go to our essay blog, they're in free lectures. Here is calculator tricks. Why do I want to use the tricks? If there is a straight way, information is available. That's why I stopped. Okay, finding power and nth root, third root using the basic calculator. You can go and watch this video. It's 3 minutes simple calculator tricks you have. You try in your own home for the third root how to calculate, and you can get the answer. No issues. Okay, if you want to be cautious before going for the examination, you need to have the 100% coverage. Then you can go that. Otherwise, it's not required. It's very rarely asked. And the answer being 87,718. Okay, this value being Z, 87,718, lower limit being 2 lakhs, and this value being 2,87,718. Here you can use one of the two formulae, 3 into 2,87,718 minus 2 into lower limit 2 lakhs. The ultimate value being 4,63,154. This way also you get the same answer. So last one, 4 bar 3 into Z value being 2 lakhs. Z value being 87,718 plus lower limit 2 lakhs. The final value being 3,16,957. So EOQ, like we have the economic lot size here completed. Like reorder level, minimum level, maximum level, we have Miller R model. Here only mugging up the formula, that's okay. Finally, we'll go for the budget, cash budget. Cash budget is similar to the receipts and payment, like for every period you have to calculate. Okay, I'll solve the cash budget now. I'll solve the same cash budget with the management accounts also. What can we do? Can we solve here? Are there? Cash budget. Okay, we'll solve here itself, no problem. There also you can, again, you can learn that. Shall I move on to the next one? So only 3 aspects are there. What are they? Economic lot size, optimum cash balance, and cash budget. So we have completed these 2. This is similar to EOQ. Most probably this may be expected in your examination. This is very rare. Anyhow, you will just understand the cash budget also. It will be useful for both the study, either FM or in cost and management accounts. Now, in cash budget, you have to prepare the receipts and payment. Okay. You are required to prepare cash budget for the month of October, November, December. So for 3 months, you have to prepare the cash budget. Yes. Cash budget. We start with opening cash balance. With that, add receipts. Okay. From the receipts, you have to subtract the payments. Payments. For what are the months you have to work out? 3 months. October, November, December. What you prepare in cash book? Receipts and payment. In T format. Here it's a vertical format. In cash book, what already received and paid is recorded. Here, what you expected to receive and payment, making the payment later is going to be recorded. So projected, that's one actual one. Okay, that's all. So from the opening balance sheet, you know what is the cash balance you have. How much you have? 35,000. That's a starting value. This is on which date? The last date of the September. The closing balance in 30th September becomes the opening balance the next period. So we'll start with 35,000 here. Opening balance being 35,000. Now read one after one. The company is developing a system of forward planning. On 1/10/2019, it supplies the following information. So these are the informations given. Right. This is what about the predicted one. You estimated these things may happen in the coming days. Now, from this, it is very clear what is that. Whenever you do cash sales, the collection will be done immediately. So I put the value here, cash sales. What about the collection in October? 5,000. What about the receipts in November? 6,000. What about the receipts in December? 8,000. But in case of credit sales, it's not guaranteed that we will get immediately. Similarly, purchases also credit, we will not pay immediately. So unless we get the ACP, average collection period, as well as average payment period, we are not aware about the real receipts and payment. Wait for that information. Over. All trade debtors are allowed 1 month's credit and expected to settle promptly. All trade creditors are paid in the month following delivery. So in case of trade debtors, 1 month later they will settle promptly. There is no any bad debt. In case of creditors, whatever the goods we purchase in the following month, we have to make the payment. Means 1 month credit. So for both the cases, 1 month credit is there. Here also 1 month. Here also 1 month. For the purchases or for the sales in September, you have to make the payment in which month? October. So the October month payment being 15,000 rupees. This is nothing but payment to debtors. Collection from debtors, sorry. Collection from debtors. And here 18,000. Here 20,000. Similarly, in the case of creditors, payment to creditors. How much is that? For October, 23,000. 40,000 rupees. 1 month delayed. Similarly, here 23,000. Here 27,000. Hope you will be now able to understand all these things. Clear? Very simple. See, as 1 month delay, you can cross verify. What is that? The sales in September remains unpaid by the end of September. Am I right? By the end of September, this 15,000 remains unpaid, means it remains debtors like in balance sheet. See? Similarly, September month purchases remains unpaid by the end of September. See? For the cross verification. Adjustment number 1 over. Adjustment number 2. On 1st October 2019, all equipment were replaced at a cost of ₹30. 14,000 was allowed in exchange for the old equipment. Net payment 16,000 was made. And 1st October, no, old assets are replaced. Old asset goes off 14,000 rupees, new asset comes for 36,000 rupees, then your ultimate payment is net 16. In your cash book, you are going to show only the net cash payment, which is 16,000. So, in October, asset replacement, payment for asset replacement. Clear? The proposed dividend will be paid in December 2019. What's the proposed dividend we have? 15,000 rupees as per the balance sheet information. This 15,000 paid in December. Okay. So dividend paid. Occasional payments. The following expenses will be paid. Okay. What are they? Wages 3,000 per month. Every month you are paying 3,000 rupees. These are the periodical payment. Every month this payment will be there. Administration also 1,500 per month. Admin payment for admin. Rent for rupees 3,600 for the year up to 30th September, paid only in October. We pay rent 3,600 per year, payable only in October. Thereafter, again, we'll pay the next year only, not every month. Clear? So we have posted all the payments here. That's all. We have completed all these things. Come on, finish up telling this. Now tell me, what is the value you have? 55,000. What about the total of this one? 6,400. Your closing balance being negative 9,100. Negative 9,100. Becomes opening in the next period negative. In the next year, 14,900 only we have. After the payment of rupees 27,500, final value being 12,600 negative, and here 12,600 negative, and two positive receipts. After that, ultimate cash balance available being only 15,400. For that period, payment being 46,500. If you subtract 46,500 from here, 3,100 will be negative value you have. So you predicted that these 3 periods you face with negative balance, you have to double cautious to make the fund arranged for the period. Is that okay? That's what about the requirement, cash budget. In this illustration, ABC Limited provides the following information. Opening cash balance 10,000 is the minimum cash balance also to be maintained. This is a very important thing. Okay. So here we have been given receipts here, cashiers and collection from debtors, purchases, payment to the creditors and expenses given. This is receipts and this is payment. Directly given. All these things are directly given, no problem here. But the problem here is opening balance 10,000, also the minimum cash balance. Any shortfall in the minimum cash balance is to be met by bank borrowings in the multiple of 5,000 and at the rate of 12% per annum. So borrow 5,000 rupees per lot, interest rate applicable for this being 12%. Or sale of marketable securities in multiple. Okay, and you have the marketable securities. That lot size is 10,000 rupees. Bank interest on monthly basis is payable on the first day of the subsequent month. Bank interest is payable for a minimum period of a month. Bank interest is payable for a minimum period of a month. Any surplus cash is to be used to repay the borrowings in the multiple of 5,000. Any surplus. See, if there's a shortage, whether you have the marketable securities or not. If you have the marketable securities, you sell the market securities, so you'll get the cash. If you don't have the marketable securities, you can borrow. The lot size of the borrowing is 5,000. The lot size of the securities being 10,000. In case of borrowing, you have to pay 12% interest per month, per annum. Otherwise, per month, 1% interest. Leaving that, rest will be easy. Leaving this, rest will be the easy. Very simple. Let me solve this illustration so that you will be able to understand easily. So, for what are the month? April, May, June, July, August, and September. Now, opening cash balance, receipts, payment. So, what are the receipts we have? Cash hits, collection from debtors. The value being 8,000, or I can write the other side, so it will be comfortable. Yes, April, May, June, July, August, September. Opening balance being 10,000, that is the minimum balance. Receipts, we have two receipts, cash hits and collection from debtors. Okay. And we have the payments. What are the payments? We have three payments. Cash purchase, creditors payment, expenses payment, payment for expenses. Let's start with this one. 8,000, 12,000, 16,000, 20,000, 24,000, 28,000. Collection of debtors 16,000, 32,000, 48,000, 64,000, 80,000, 96,000. Similar these things, expenses 8,000, 12,000, 16,000, 20,000, 24,000, 28,000, and 12,000, 24,000, 36,000, 48,000, 60,000, 72,000, 12,000, 5,000, 7,800, 2,950, 27,000, 20,000. Now, total of expenses, come on. 32,000. Here, 41,000, 59,800, 70,950, 1,11,000, 1,20,000. Initially, how much we have? 34,000 along with the opening cash balance. The final balance is, okay, receipts minus payment, 2,000. What is the minimum balance they need to have? 10,000. There's a shortage. In case of shortage, what happens? Shortfall. First, they have to go for the options. Sale of marketable securities or borrow. Borrow will carry 12% interest per annum. It should be in the lot of 5,000. Marketable securities in the lot of 10,000 in case of shortfall. If you have surplus, what happens? If you have surplus, if there is any borrowing, first of all, repay this. Repay the borrowings. Or you can go for investing in marketable securities. Buy. Loan can be repaid and marketable securities can be purchased fresh. It means investing. That too having the same lot size 5,000 and 10,000. Now, here we don't have any other options. We have to go for, we don't have the marketable securities. We have to go for borrowings only. Borrow. Borrow or repay. How much is that? 10,000 rupees. Per lot is 5,000 rupees, but need to maintain at least 10,000 means unless we borrow 2 lot, we cannot manage. What about the marketable securities? Buy or sell? No, we don't worry about that. In case of borrowings, you have to pay the interest also. Interest will be payable only in the next month. So, with that 2 borrowings, now the value being 12,000. This becomes opening for the next period. Next period, what is the total amount you have in your hand along with the opening balance? 56,000. 41,000 is used and you have 15,000, but you have to pay the interest. How much? For the 10,000, 1% per month. 100 rupees interest is payable. After the payment of interest, you have balance only 14,900. 14,900. So minimum balance 10,000. Apart from that, you have 4,900. Cannot be used for settling the loan also. To pay off the loan, I need to have 5,000 rupees. I don't have, so 14,900 only becomes opening for the next period. With the other receipts in the next period, 78,900. Subtract this value. You have 1,900. You have to pay the interest first of all. Finish up the interest better. You can put the interest also here, so that it will be very comfortable. 1,900 minus 100, 19,000 you have. Minimum how much you need to have? 10,000 rupees. Beyond that, how much you have? 9,000 rupees. If you have excess, what you can do, you have 2 options. One is repay the loan, or you can purchase the marketable securities. But in case of marketable securities, you need to have 10,000 rupees, but you don't have 10,000 rupees. So then what you can do? You can simply repay this. 1 lot can be repayable. So out of 10,000, 5,000 is repaid. Now after that, the balance being 14,000. Next period, 14,000. With that period, receipts and payment, it becomes 98,000 minus 7950. You have 27,050. You have to pay the interest here. After payment of interest, you have 27,000 rupees. As you have surplus, how much surplus you have? Beyond 10,000, you have 17,000 rupees surplus. First, you can repay if there is any loan. Is there a loan? Definitely, there is a loan of 5,000. I can repay that 5,000 rupees loan. After the repayment, also still have surplus 12,000 rupees. Then I can invest in the marketable securities by purchasing a lot. The lot size being 10,000 minus negative. Buy is negative. In case of loan repayment, is negative. Borrowing is positive value. securities selling will be positive value. Is that okay? So negative value is put in the brackets. Repayment is negative, buying securities also negative. Now ultimate balance being 12,000 rupees. Start with the next year, 12,000 rupees, 1,16,000 rupees, 1,11,000 is subtracted. So I have receipts and payment 5,000 rupees. Do we have loan? No, we don't have the loan, but we don't have the minimum balance of 10,000 rupees. As we don't have the minimum balance of 10,000, shortage is there. In case of shortage, we can go for these two options. Either you can sell the marketable securities if it is available, else you can go for the borrowings. Already we have the marketable securities rupees 10,000. We can sell that, so we'll get the cash here. After this 5 plus 10, now the closing balance become 15,000. This is nothing but the opening balance for the next period. With that 15, you have to add these two. 1,39,000. If I subtract 120, I get 19,000 rupees. Now, as we have the surplus by 9,000, what can we do? In case surplus, repayment of debt is possible, but we don't have the debt. Or we can go for purchasing marketable securities. Yeah, of course we can do, but the lot size is 10,000. We don't have 10,000 rupees. We have surplus only 9,000 rupees. So naturally, the closing balance remains 19,000. This is what about the planning for the fund requirement. How can we finance it? So this is the option included in cash budget. Else it's similar to the normal cash budget only. Clear? Come on, make a note of it. So for the working capital requirement, how can we finance? Okay, the source of financing working capital being classifiable this way. Okay, 4 varieties are there. One is all about spontaneous source of finance. Okay. Now, these are not actually created, but automatically you will be getting trade credit, bills payable, accrued expenses, and all. Okay, all these facilities are spontaneously available, or you can go for getting the cash credit from the bankers. Okay, customers allowed withdraw funds from the bank up to a credit limit like overdraft, and similarly we have the being overdraft facilities. And working capital loan also you can get. Working capital requirement will be satisfied by the working capital loan from the banker. To the maximum extent, loan may be recommended by tandem committee is usually offered. Maximum permissible bank finance. In this particular case, we can see an illustration related to the tandem committee also. Tandem committee also. We'll see the illustration in that. bill purchases and discounts and line of credit, letter of credit, guarantee, funded interest term loan. So these are the sorts that small informations are there. Negotiated sorts like commercial papers, factoring, all these things are there. Right. So commercial paper and factoring, I need to explain in detail. The rest of things are very simple. Apart from that, we may have some loan facilities for export like pre-shipment and packing credit, post-shipment finance and all. Apart from all these things, the most probably for the calculations part, we need to understand maximum permissible bank finance. Recommended by Teja committee, Tandon committee, core committee. Anyhow, we usually come across with the Tandon committee. As per the Tandon committee, the maximum permissible bank finance for the working capital requirement, if you go and ask for the working capital requirement, loan for working capital requirement, the banker will decide based on three options. Based on these three options. Is that clear? Now, calculate maximum permissible bank finance as per the Tandon committee here. Right. See here. Calculate maximum permissible bank finance as per Tandon committee's recommendations from the following details. Current assets 200, current liabilities excluding bank borrowings 50, core current assets being 30. So whenever we talk about current liabilities, it should not include the bank borrowings. You have to understand. So three terms are very, very important. One is current assets. Another one is current liabilities should not include bank loan because we approach for bank loan only. As we approach for the bank loan, there should not be existing bank loan. So you have to remove that and core current asset. These are the three details we need to have for determining maximum permissible bank finance. Tandon committee maximum permissible bank finance 75% of the current assets minus current liabilities other than bank finance. This is the first model. 75%. Current assets being 200, current liabilities other than bank finance being 50. Come on, what is the final value? 112.5. 75% of next one is 75% of current assets. Okay, minus current liabilities other than the bank borrowings 50. So 100 will be the answer. Last one being 75% of current assets other than core current assets. Core current asset here being 30. From there, current liabilities other than bank borrowings can be subtracted. What's the final value? 77.5. So if you want to get the loan for your working capital requirement, bank and finance, one of the three values calculated as per the Tandon committee's recommendations. So that's how you can source your fund requirement. Clear? Next, a comprehensive illustration. So here I am going to calculate the working capital requirement first and then calculate the MBBF, okay, maximum permissible bank finance, both put together as a single illustration. Okay, XYZ Company Limited is a pipe manufacturing company, its production cycle indicates that materials are introduced in the beginning of the production cycle. Wages and overheads accrue evenly throughout the period of the cycle. Okay. So this represents the value required for calculating work in progress stock. Wages are paid in the next month following the month of accrual. So wages will be paid 1 month delay. Work in progress includes full units of raw materials used in the beginning of the production process, and 50% of the wages and overheads are supposed to be to the conversion cost. So in case of work in progress, okay, in case of finished goods, work in progress stock. Details being production of pipes being 12,000 units, duration of the production cycle being 1 month, and raw materials being 1 month consumption. Everything is given. Now come on, find out that. What about the raw material stock? Raw material stock. How much? 1 month consumption. Cost of raw materials being 60 per unit. So 12 lakhs unit into 60 rupees multiplied by how many months the raw materials held? 1 month into 1 by 12. 60 lakhs. Second one being finished goods stock. 12 lakhs unit. For the finished goods, you have to take up all the cost of productions. 60 plus 10 plus 20, 90. How many months in stock? 2 months into 2 by 12. This value being 180. Work in progress stock. Okay, work in progress stock. In case of work in progress stock, for material, 12 lakhs into 60 rupees, we introduced 100% at the beginning itself, and it remains in production cycle for 1 month into 1 by 12. Into 1 by 12. In case of conversion cost is other than material, labor and other overheads. 12 lakhs into 30 lakhs, 30 rupees into 1 by 12, but we introduced only 50% currently. Wages and overheads are introduced only at the 50% rate, but raw materials are introduced at the beginning, means 100% already introduced. So 12 into 30 into 1 by 12 into half. This is 15, this is 60, then naturally work in progress stock value being 75 lakhs. Credit allowed by the creditors, 2 months, 1 month. So we don't get the sales price, means credit purchase and cash purchase details. So we assume the entire purchases being credit purchases only. 12 lakhs units. For every unit 60 rupees material purchased, we assume the purchased unit is equivalent to the consumption both, and for that payment we made 1 month delayed, so into 1 by 12. What's the value? 60 lakhs. Similarly, credit given to debtors 2 months. So in case of debtors, what happens here? In case of debtors, full cost model means you can take 100, or cash cost model means amount locked in debtors will be taken, which is nothing but cost of goods sold. 60 plus 10 plus 20, 90 will be taken. So 12 lakhs unit into 90 rupees into how many months? 2 months into 2 by 12. This value being 180 lakhs. So nothing we have further. Wages is also there, outstanding wages. Wages are paid in the next month. Outstanding wages. For the 12 lakhs units, what is the wages payable? 10 rupees. But we delay 1 month into 1 by 12. Then the ultimate value being 10 lakhs. Then current assets being 495. Current liability being 70. Working capital requirement being the difference between these two, 425. Here we have been given core current assets being 100 lakhs. Now I am going to apply the Tandem committee's maximum permissible bank finance also. As per maximum permissible bank finance, 0.75 of current assets minus current liabilities is one format. In current liabilities, bank loans should not be included. So 0.75 into current assets, this is 425 only. So 495 minus 425. What's the final value? 318.75. 318.75. Is that clear? In the another approach, 0.75 of current assets from their current liabilities other than bank loans should be subtracted. So 0.75 into current assets 495, current liabilities 70 is subtracted. So this value is lesser, 301.25. Clear? In the last option, we supposed to subtract what? Core current assets. 0.75 into current assets minus core current assets. From there, you can subtract the current liabilities other than bank overdraft. 0.75, 0.75 into current assets, in this case being 495 minus core current assets being 100 lakhs minus current liabilities being 70 lakhs. The value being 226.25. Clear? That's all. Working capital requirement we already completed. So here I included the tandem committee's maximum permissible bank finance. So the rest will be the usual. So everything is over for the CA students. I need to cover up only two mode of financing in detail. One is factoring, another one is commercial papers. Rest you can manage understanding by reading this. Okay. If it is clear, text me. Now, so let's see the concept called factoring. The concept called factoring. In factoring, okay, A and his customer, A and his customer, okay. So what happens here? A sells the goods to customer, right? But he will not wait the money to be collected. Immediately, B, to whom the invoice is sent, okay, invoice is sent. Sir, I have made so much sales, sir. Pay me the money. B will remit a major portion ahead, 80%. Sales is made 100 rupees. Invoice sent to B that we need to collect this 100 rupees from various customers. And 80 rupees immediately paid. Later on, B sends the invoice or statement, whatever it may be, amount recoverable from the concerned customer by B to the customer. and gets the payment later on. Okay, this is the first installment. Second installment may be after the collection, B usually deducts his charges. Okay, collection. From there, already 80% payment made, right? So prepayment. Okay, 100 rupees prepayment, 80 rupees made. From that, their charges is subtracted, probably 5 rupees. As prepayment is made, interest will also be deductible, probably 2 rupees or 3 rupees. And what about the bad debt if amount not recovered? Okay, maybe around 5 rupees not recovered. So overall 92 rupees deducted, balance 8 rupees finally paid. Second payment. Payment number 1, payment number 2. Sometimes while making the payment, bad debt is not subtracted. 13 rupees is paid back by B to A, taking the responsibility of non-collections liability or loss by B himself. Okay, so that is called non-recourse. Non-recourse. Recourse, non-recourse. Two options are there. If the amount not collected, then you are responsible. Like B demands to A to accept the bad debt, then it's called recourse. No, sir, that loss will also be taken by myself if there is any, then it's called non-recourse. Similar to delegatory commission, you might have studied in consignment. The same logic here we have. Here, B taking this role is named as factor. The process what is undergoing is called factoring. Because of this mode, A gets the money in advance. He gets the money today itself, right? He doesn't want to wait for the long period. He gets the money today itself. That's an advantage. So, recourse factoring. Bad debt loss is borne by the seller. Recourse means bad debt loss is borne by seller. Non-recourse, usually we call factoring itself non-recourse unless specifically stated that non-recourse is otherwise named as full factoring. Okay. So, factor finances the seller and bears the bad debt also. That's called non-recourse or full factoring. Advance factoring or maturity factoring. Payment will be given in advance for a small interest or only after the collection period I will pay. That's the two modes are there. Usually advance payment will be there because A goes for this mode only for getting the money today itself. The finance requirement is fulfilled. Invoice discounting. The otherwise the invoice given to B, for the invoice, he gets around 92 rupees or 97 rupees. Balance will be considered as discounting the invoice. That's similar to the discounting of the bill with the banker here. Invoice is discounted with third party. That third party is called factor. Okay, prepayment and credit administration. Okay. And finance factoring, other things are also there. Bulk and agency factoring, we have that. So, in factoring, an arrangement in which factor collects the accounts receivables for a fee. So, other things already I explained, no, the same is available here. And advantages also there. How can we decide whether the factoring is good or not? So, you have to find out what is the factoring commission they demand, what is the interest they charge. So, we have these two costs. What are they? Interest as well as charge. Okay. If I administrate myself, what is the cost? If I administrate myself without factor, it costs me 8 rupees. Definitely my cost being 8. If I am outsourcing to the third party under factoring concept, then he takes care of that and he demands 7 rupees. Okay, pretty comfortable. So you always consider whether can we have it administrated ourselves to collect it in due course. And what is the cost for that? It may be 8 rupees. Rather than it may be transferred to the other burden like and where it costs us 7 rupees. This may be cheaper, you can go. Okay. So that's the main thing. So main advantages of factoring being the firm can convert accounts receivable into cash. So immediately they have the cash rather than it may be remaining as an asset account receivable in the balance sheet. Factoring ensures a definite pattern of cash flow. You will be regularly getting the cash. Once the sale is made, immediately 90% or 80% you will be getting the amount in advance. And continuous factoring eliminates the credit pay department. So we don't have the credit department also to administrate whether we need to collect the money in due or not. Savings and cost of funds invested. So if I want to give the amount in credit or sales in credit, we need to source the fund. No, for the interest is there. We no need to worry about that. Savings in bad debt and eliminates collection costs. These are the savings we have. These are the cost we have to bear. So you have to compare these two and decide whether the factoring is good or not. Clear? So the next one is all about commercial paper. Commercial paper. So in commercial paper, you will be getting the illustration like this. It's very simple. Very simple. We'll finish up the illustration and then we go for the theory. A commercial paper of the face value 5 lakhs. So face value being 5 lakhs is issued at 480 for a maturity period of 120 days. So here you just see 0, 1, 2, 120 days. Face value being 5 lakhs, but issue price being 4 lakhs 80,000. So 4 lakhs 80,000 rupees is the issue price, but you have to redeem on face value by the nth period. Nth period means 120 days. Now, what is the hidden rate of interest? Like again, interest rate calculations only. So 480 becomes 500 means what is the rate of interest? So 20 rupees you are paying interest for 480 for how many days? 120 days. For a year, how much it should be? 360 divided by 120. Come on. What's the value you get that you can represent in terms of percentage? Hope it is 12.5%. The hidden rate of interest belongs to this category is found out this way. Is that clear? Clear? Hope you will be now able to understand. But the main theory related to the commercial papers are being this one. Commercial paper unsecured promissory note, like it's a money market instrument. Okay. Issued by a firm for a short term requirement, usually 15 days to 1 year, not beyond that. Buyer could be another commercial banks, mutual funds, or financial institution. To them, you can issue and get the money. In return, interest based on the maturity period and prime lending rate, you will fix that interest rate. All right. Maybe 12.5% or 15%, like. Advantage, it may be low cost and issue charges, placement fee to the dealer who sells the CPs. Yeah, of course, we need to pay the placement fees. That's how the commercial papers are issued. And which is regulated by Reserve Bank of India when the CP can be issued in multiples of 5 lakhs. It should be issued by multiplications of 5 lakhs, and CP duration should be anywhere between 15 days to 12 months. For issuing CP, the company's net worth should be more than 4 crores, else it is not possible. And CP can be redeemed only on maturity date, okay, not before that. And CP issues requires credit rating P2 from CRISIL or A2 from ICRA. The hidden annual CP cost, commercial paper cost, is this one. So we have already calculated the rate of interest in the earlier illustration. So it's very simple. And what are the advantages of commercial papers we have? It's a transfer. It's very simple. So other things are very like a bond, like you'll enjoy the benefits for the short term. You can enjoy all this benefits. So financing may also be one of the main requirement to understand. Okay. So with that, all the concepts for the CA Group 2 financial management is over. Okay. Do lots of practice to master here.